Yeah, so for the value strategy, we expect high and sticky inflation. We expect slowing growth on the back of tighter monetary policy and lacking fiscal stimulus. What does that mean for the value strategy? Well, it really means that utility companies will perform really well in this volatile environment, in this environment where they are able to pass through inflation. And so as a result of that, we have a much greater exposure to utilities than transport infrastructure, which is more GDP sensitive. Transport infrastructure that we own very much is leveraged to the opening of economies around the world, whether it be the openings in China, which will benefit our airports, our rail, or the delayed opening that we've seen in Japan for our Japanese rail companies. We have exposure there which should capitalize on this recovery over 2023. What's important as we get towards the end of the year, though, is to really understand whether economies are moving and whether that means that we have to pivot into more GDP sensitive names as economies start to recover through 24 and 25. But that is the current outlook for the value strategy for 2023. Yeah, so there are a number of key advantages for the value strategy. You know, the first would be the way we construct our universe to really make sure we capture all index unaware type opportunities, whether it's contracted renewables, which you wouldn't see in indices or a number of our competitor portfolios, whether it's actually excluding very volatile cash flow assets. The way we construct our universe, the definition of infrastructure is very unique and we think very, very critical. Our team is one of the largest teams globally in listed infrastructure with a 17-year track record of managing the value strategy. When you think about the construction of our portfolio, we invest in an index unaware way. And what that means is we can generate from a bottom-up perspective a substantial amount of alpha by investing in assets that really others wouldn't invest in. So we aren't forced to lean on an index. We aren't forced to invest in certain assets just because they're in an index. We can pick the best risk-adjusted return opportunities we see in current markets. And another key advantage is our ESG sustainability process. We think it's one of the best in the market. We can capture ESG factors and risks through our cash flows. We also capture it through our hurdle rate with our scorecard. Forward-looking scorecard looks at over 10 factors, E, S, and G. And what that allows us to, again, do is not only take those risks into account in our portfolio, but also take advantage of value added that we see coming from E, S, and G that may not be captured in your MSCI, your S&P, and other third-party type ESG providers. I guess the final big advantage is the way we think about risk management. So we think about risk management, we think about mitigating downside risk all the way through our process, whether it's in the construction of our universe, the way we analyze companies, the way we construct our portfolios through different scenario analysis, or the way we use Northfield factor risk model, similar to a Barra type multi-factor risk model, to price individual risks on a theme, sector, and region basis, so we are able to understand the volatility of companies, themes, sectors, and regions going forward. Yeah, so risk management is crucial to how we think about infrastructure investment. When we construct our universe, we exclude volatile cash flow assets. That's one way we minimize risk. When we analyze companies, the analysts look at stocks very much on a bottom-up basis, understanding the risks within individual companies. They think about them on both a qualitative and on a modeling basis. When we construct our portfolio, we have guidelines. We also look at scenario analysis, which looks at the upside and downside of companies, which allows us to really manage that risk for positions within the portfolio. Finally, the way we think about risk when the portfolio is constructed and the way we shift the portfolio is crucial. So firstly, we use that multi-factor risk model, Northfield, similar to BARA, which we've constructed over a number of years to really price risk, to understand the risk budget of our portfolio. And then in addition to that, we have a risk oversight committee based in New York where we do a quarterly review, really understanding the risks within our portfolio and really helping the portfolio managers to shape any construction of the portfolio going forward so we can minimize the risk and really invest in those key risk-adjusted returns going forward.
请上网搜寻富兰克林存基金。
投资一定有风险，基金投资有赚有赔，申购前应详阅公开说明书。